Good morning. The top stories from Sky News live in the city. Food inflation in the UK slows, but is still up more than 15% on the year. Asda to acquire petrol station operator EG Group's UK and Ireland business in a £2.3 billion deal. I'll be speaking to the Asda chairman, Lord Rose. The United States edges nearer to a deal to raise its debt ceiling. Plus, looking for a strike, I'll be speaking to the chief executive of Hollywood Bowl about the UK's 10-pin revival. A very good morning to you. This is Ian King Live with me, Wilfred Frost, an hour of business and economic news from the heart of the city. Now, there are hopes that food inflation in the UK might have peaked following months of price hikes squeezing household budgets. Research by the British Retail Consortium and Nielsen shows a 15.4% rise in food inflation in the year to May. It's the second fastest annual increase that the BRC has ever measured, but it is down slightly from April's record-breaking increase of 15.7%. It means that someone who spent around £20 in a food shop a year ago would now be paying a little over £23 for the same basket of goods. Overall, shop price inflation rose from 8.8% to 9% between April and May, according to the BRC, which is an all-time high. Well, in a moment, we'll hear what the Asda chairman, Lord Rose, has to say about food inflation. I've just been speaking to him moments ago about the news that Asda Group is to acquire the petrol station operator EG Group's UK and Ireland business, creating a company with combined revenues of nearly £30 billion. It's a story that was broken by Sky News last week by our city editor, Mark Kleinman. The £2.27 billion deal will mean the acquisition of around 350 petrol stations and more than 1,000 food-to-go locations. Lord Rose says the deal will bring Asda's heritage to even more communities in the UK, and I began by asking him what exactly he meant by that.
We're going to create an omnichannel retail champion in the UK, and we're going to be number 2 effectively in the UK grocery market. We're going to have a business which is going to have around £29 billion of turnover. We're going to have around 1,800 sites. We're going to have a business which will allow us to extend the Asda brand to a wider community than we currently can do, mostly because we're going to have food service and we're going to have convenience, which we haven't had in strength in the Asda business hitherto.
It's interesting that you mentioned nearly 2,000 sites. I mean, much of the last decade, the debate in groceries was around online food sales, something you know a lot about given your prior chairmanship of Ocado. Is the pendulum swinging back more to traditional retail than it has done for the last 15 years or so?
No, I think the key word, Wilfred, is omnichannel. Today, if you're going to be somebody who's going to compete in this very competitive world that we compete in, you've got to be able to touch all places. So we have to give customers what they want, where they want, how they want it, and we will do that. So we will do it in petrol forecourt stations, we will do it through convenience, we will do it through our online deliveries, we'll do it in our convenience stores, in our supermarkets, in our hypermarkets.
I read through the press release in detail your comments of your various colleagues throughout the business. What's not mentioned is the debt position of the company. Is it fair to say that that was a driving force behind the deal as well, that it might give the combined business a better chance to refinance, given that rates have risen, and what is overall a very leveraged business still?
The main reason that we have done this deal is one that we have been looking at for some time, is that when we took over the Asda business some 18 months, 2 years ago, we knew that we had some massive strengths, but we knew we had some opportunities to build onto that, and that was the convenience part of our business. You'll have recalled that some months ago, a while back, we acquired 119 sites from the co-op, and we've now acquired or will acquire another number of sites which will allow us to extend our convenience business. Now, when you talk about the debt position in terms of leverage in Asda won't materially change going forward.
But this will allow you a benefit of the deal is a hope that you'll be able to refinance some of the debt from EG now across the combined business?
Well, it is true to say that in doing this transaction, it will allow EG to delever a little bit at some point in time. But the primary purpose of today and what's driven today and our strategic direction today is about driving the Asda business. When we bought the Asda business back in 2021, we were ambitious to become, for instance, number 2 in the retail sector in the UK. We're currently number 3, and we're ambitious to be number 2. Doing what we're doing today will allow us to be able to get onto that roadmap and move on in that direction.
Let's touch a little bit about the outlook for food prices here in the UK. It's been a hot topic, of course. Do you think the worst of the food price inflation has been and gone, or is there higher rates of inflation still to come?
Well, I'm hopeful that we are at the peak and that we will steadily see decline now. But, we sadly haven't been able to see the quick declines that were speculated on earlier in the year. It's a very complicated situation causing this inflationary situation. But I must say, not just Asda, all retailers, Wilfred, are very, very efficient. We are a very efficient industry. In real terms, the cost of food, the cost of clothing and the cost of electronics has come down over the last 20, 30, 40 years, largely due to the efficiency of retailers. And governments of any complexion owe us a debt of gratitude. And this recent speculation over the last couple of days about fixing prices, it's frankly, this is rather backward looking. It reminds me of a man of a certain age of a prices of incomes policy that we used to have in the late 60s.
Let's touch on that a little bit, because clearly an argument was successfully made, that the oil and gas majors did deserve to pay a one-off windfall tax. Why do food retailers not deserve either to see price controls or face a windfall tax?
Well, let's just take this very simply, Wilfred. Look at the profit margins of food retailers and look at the profit margins of the energy people over the last 18 months, and the answer will be very clear. Retailers make between 3 and 4% margin. That's what they make. And that's if you can compare that against margins made by other industries, and let's take the energy industry, that's a completely different. That's comparing an apple and a pear. We're a very efficient industry, and we are very competitive. And with the number of outlets that we've got here now, the consumer has got massive choice, and in real terms, fantastic value for money.
No, it's definitely a fair point. Low single-digit profit margins clearly is not as excessive as some businesses. I guess the question for here and this year ahead, when there's clearly cost of living pressures, we can't see with Asda because it's not publicly listed the detail that you can see in other margins. Would you, and do you think your colleagues at other big food retailers, pledge not to increase that margin during this tricky time for consumers?
We've all lent in. Look at the profit results that were produced by our competitors and ourselves. Most retailers or grocery retailers' profits over the last year have gone backwards. Whether you're talking about Tesco, whether you're talking about Sainsbury's, whether you're talking about Asda, they've all gone backwards. We, as an industry, have lent in and done some very, very good work in making sure our customers get great prices. We had an operation well ahead of the government's proposal last week about locking prices down, which we call dropped and locked, where we fixed prices for nearly a year at the beginning of 2022. So we're very active in making sure we stay close to our customers and give them the deals that they expect. But it's tough because if you look at commodity prices as they come through, for all the reasons we know, they've been going up. Whether it's raw material prices, whether it's oil, whether it's wheat, whether it's butter fats, we've seen massive increases. Your question earlier was, have we reached the peak of that? I would hope so. And going forward into 2024, let's hope that we reach better times.
Just touching on fuel retail prices, petrol prices as well, something that, of course, you're heavily involved with too, somewhat in the eye of the storm here in terms of your exposures. The CMA recently reported that at least one supermarket has significantly increased its internal forward-looking margin targets over this period. There was speculation they were referring to you. Is it unfair, though, to look at Asda and EG's relative price increases of fuel as opposed to the absolute, because on absolute levels you're fairly low and you're starting from a point where prior owners, Walmart, the US owners, wanted to drive footfall into the stores and make a loss with fuel retail. Just talk us through some of your current pricing and thinking on that.
Well, the thinking is quite simple, Wilfred. We were and have been for many years the price leader amongst the big four supermarkets. We are currently the price leader amongst the four supermarkets. We are committed to be the price leader amongst the four supermarkets, full stop.
Fair enough. So that might, though, mean ongoing percentage increases, but in absolute levels, you'll maintain your price leadership.
We will be the cheapest amongst the big four.
Fair enough. So just coming back to the bigger picture, Lord Rose, do you understand the predicament the government faces when it has to weigh up whether to impose price controls, whether it has to weigh up to impose windfall taxes, or would it be a terrible error for the long-term future of British business if the government pushed further than it has done already, more than just rhetoric, into the food retail space to try and impose some price limits?
Listen, I'm not an economist, but I'm a businessman. I've been in business for 50 years. You can't interfere with market forces. At the end of the day, you have to trust us as retailers to give our consumers the best deals. Our customers are very savvy. They're very smart. They know that we're working hard to do things on their behalf. We will continue to do so. Intervention always brings in unintended consequences. And personally, I would not recommend it.
Lord Rose there on the topic of food inflation, suggesting the worst of it might well be behind us. The Asda chairman there on the day that they announced a £2.3 billion deal with EG Group's UK and Ireland assets. Now, moving on. After weeks of political acrimony, Congress will finally vote tomorrow on the Fiscal Responsibility Act to raise the United States debt ceiling and prevent a fast approaching default. President Biden and the Republican House Speaker, Kevin McCarthy, agreed a deal late on Saturday night that, if it's approved, will allow the federal government to continue to borrow money. I'm joined now by Maurice Reid, a partner at the global consulting firm Actum. Maurice, great to see you.
Good morning.
Good to see you here in person in London as well. So first step, how significant in the process of extending the debt deadline is it that there's a deal between the two main protagonists, McCarthy and Biden, versus still needing to get through Congress? Could it still fall apart in Congress?
Sure, absolutely. You have both wings of the parties that are not crazy about this. But as you look at McCarthy, I think if you look from the perspective of him versus Biden, he's clearly the winner. Biden, the White House underestimated his ability to push this type of package through his caucus. He did it. And then he had the backing not of just the caucus, but also the Senate Republicans who are saying, listen, Biden, you have to deal with him. We'll deal with this once you've passed it. So I think he is, if you look at the two guys, I think he's the winner so far.
Interesting. And so just talk about going through Congress, because I guess there hasn't been as loud criticism only over the last 48 hours from any Democratic members, but the sort of Freedom Caucus, as it's referred to often, that contains a lot of supporters of the former President Trump within the Republican Party, they don't like this deal. So might Republicans not back it?
Well, you'll have those guys who will never back anything because they're Donald Trump supporters and they want to make sure that Donald Trump wins everything. So expect that noise. I think that his caucus will stay fast. On the Democratic side, you're starting to hear Democrats are upset that Biden actually mishandled this. They wanted to run out the clock. It actually worked against them. So you'll start to see more Democrats, particularly the far left Democrats, starting to complain that this is going to hurt their constituency groups the way Biden's handled this.
But there's enough in the middle for the deal.
Of course. This is also where Biden's going to say that he's a middle of the road. He's a pragmatist. He works with both sides. But you'll see a lot of squawking and noise on both sides. So
just talk us through why you're saying that this has been a better negotiation on the part of McCarthy on the Republican side than Biden, because you could look at it and say that the cuts to spending are marginal, much less so than, say, when Obama in 2011 faced a similar threat. Why is this a win for McCarthy and the Republicans?
So two things. Number one, McCarthy, the way he came into office, no one expected him to have the authority or the backing of the caucus, given it took so long to become Speaker. Right, that's number one. Number two, once he got the package through, he called the White House bluff. They didn't expect him to get it done. Once he got it done, he had the force, the momentum behind him to stand toe-to-toe with the president. As you originally remember, Biden met with the big four. It then went to the big two. Then it went to the speaker. And the speaker rose to the occasion instead of shrinking in a moment. So he, I believe, will be a net positive on this regard. Biden just wants to get this done, right? Frankly, he needs it past him so he can start to focus on re-election. You'll see this can move very quickly to the presidential conversation because Trump will jump on this no matter what.
So just interesting, you mentioned there that Biden will perhaps lean on the fact that he's doing a sort of cross-party deal here and that he deserves credit for that. What does it say about the prospect of major legislation between now and the next presidential election?
It's just very interesting you mentioned that because this will embolden the Republicans to block Biden. They see this as an opportunity where they've been able to hold the caucus together. push back on the president. So I expect that the president will move, instead of a legislative agenda, to a Rose Garden agenda. If you remember what we did with Bill Clinton when we were in office, you just started to run things from the Rose Garden. You start to use the executive privilege instead of trying to work through Congress. So it'll be a very interesting thing because Republicans will feel much more empowered and they'll start to push back on the president's agenda.
Really interesting. Let's just, whilst we've got you here in London, Morris, touch on 2024. Firstly, I mean, there's been so much focus on the Republican nominee. On the Democrat side, is it 100% lock that it's going to be President Biden?
It's 100% lock. And just 2 weeks ago, the president had his big donors in because he realizes that if he can move very quickly to get $1 billion, and that's a billion with a B, locked up, soft circled, as they like to say in the money world, he can move very quickly to making sure that no one, there's Robert Kennedy Jr. that's out there, is really marginal, but if he gets $1 billion, he moves very quickly. But the funny thing is, if you think about the Republicans in the way that DeSantis had a disastrous opening announcement, on Twitter. And this really shows that he's not ready for prime time in a lot of circles. And this is obviously what Donald Trump does very well. He knows how to play to the media. He knows how to orchestrate big events. So this really undercut DeSantis, although he did raise, I think, $10 or $12 million in one day on the back of this debacle.
So you think Trump will be the Republican nominee?
I think right now it looks likely that he'll be the Republican nominee. He's probably the only guy who can't beat Biden. The funny thing is, DeSantis, maybe some others could be more of a threat to the president.
And just, sorry, one final thing going back. You mentioned RFK Jr. that a lot of people here might not know as well. I mean, he's not thought to be a genuine challenger, but he is polling, interestingly, in double-digit percentages, low double-digit percentages. Could that be an issue for Biden because it will make him have to join the debate stage earlier in the year through the primary season, and that might expose perhaps some of his frailties? Or is that not really an issue? Do you think Biden sails through and the first debate will be in, a month before the election?
Yeah, I think there's two reasons why he's polling well. Number one, he is a Kennedy, so there's still nostalgia for there. The other thing is he's running on a populist campaign, right? He's running on issues that people are talking about and care about. So those are the two things. I think if Biden gets $1 billion, this is really not going to be a factor. I think Kennedy is maybe looking at the next shot, just as DeSantis, right? He's 44. You run in America, you run to lose, to run to win, right? So DeSantis could be setting up for a bank shot as well.
Morris, great to see you. Thanks so much for joining us.
Thank you.
Morris Reed, partner at Actum. Right, some other stories now. Only a third of UK hospitality businesses say they're optimistic about their future because of high energy prices and rising food costs. Pubs, bars and restaurants say their energy prices have surged by an average of 81% over the past year, on top of rising food and wage bills. Industry bosses are warning that some venues will be forced to shut for good unless cost pressures start to ease soon. Meagre savings rates offered by some high street banks are shortchanging customers by hundreds of pounds every single year. That's according to research done by the consumer group Which, who are encouraging people to shop around for the best possible deal. Right, as countries struggle to reduce their carbon emissions, carbon removal is seen as key to helping to limit global warming to 1.5 degrees. It includes directly extracting carbon dioxide from the air, as well as planting more trees to absorb it. The tech startup Curate has just secured £5.3 million of pre-seed funding to develop its platform, which buys carbon removal credits. And joining me now is Marta Krapinska, co-founder and chief executive of Curate and UK lead at Google for Startups. Thanks so much for joining us. Very good to see you.
Thank you so much for having me.
So you've announced this deal, raising £5.3 million. So it's a huge congrats on that. But just first of all, talk us through what exactly Curate does. What's the service that you offer?
Yes. So as you very rightly pointed out, it is absolutely paramount that we reduce carbon emissions as much as possible. And actually, UK is a very exciting place because we have the first legal definition of net zero, which means as an organization, you have to reduce emissions by 90% and then remove the rest. And we are helping with that last bit, with the removing the rest. A lot of us have heard about carbon offsets. A lot of it is about protecting existing carbon sinks like forests or maybe moving to sustainable fuels. A carbon removal is when you actively sequester carbon out of the atmosphere. And that might be through different methods, from engineered methods like direct air capture to working with soil carbon, for instance. So what we do is we look at all of the global providers of carbon removal. We've developed our own proprietary process to review their impact, integrity, and scalability. And then we buy those carbon removals, pull them into a portfolio that's de-risked and always looks at all of the methods in the round. And then we sell that on to clients who wish to remove their residual carbon emissions.
So that's really interesting. So, I mean, it's not so much advising a company, if you start doing this in your process, you'll emit less carbon. It's kind of a carbon trading credit platform.
Indeed. And I have to again say it's incredibly important that organizations do their carbon accounting properly. It's a very, very complex process, and there are organizations that really specialize in doing this bit. Where we come in is once you've got your carbon accounting done and you know that you're left with a residual of, say, 1,000 tons or 100,000 tons, in fact, when it becomes really, really exciting, because actually part of the challenge of carbon removals is that there isn't very much stock of high quality supply today. And these are clients we are particularly excited to work with, because then with those opportunities, with those transactions, we can go and help set up more carbon removal supply that will get us to 10 billion tons that we need by 2050. So the IPCC talks about carbon removal being required to the tune of 10 billion tons by 2050. You've got a huge industry to build here.
And so there's been quite a few false dawns, not just in recent years, but the last 15 years in terms of the carbon offset and carbon credits market. Why is now different? Why do you think this market will really take hold? Like everything, it's not just about the idea. If it doesn't face a financial reality, it kind of fades away.
Definitely. And I think one of the things we really have to try and do is to clean up the language. So we have a dual structure. Curate is the startup, the tech startup that I'm the CEO of. We also have a sister NGO called Rethinking Removals. And we're talking about market making for carbon removals. It's a new category and we need to clean up the language. A lot of the carbon offsets would be what you call a protection credit or a reduction credit. So you're reducing how much carbon is being emitted, or you're protecting an existing carbon sink. A carbon removal is a different type of asset, is a different type of credit. So only about 4% of all carbon offsets actually remove carbon. And again, we're going back to the IPCC report that talks about how we need to maximally reduce emissions, but we've already left it too late. So we need to build those time machines, so to speak, to actively sequester carbon from the atmosphere and store it away safely for hundreds and thousands of years.
And just finally, whilst we agree here, I'm interested how you found going through this fundraising round. I mean, of course, public markets have fallen from their peaks a few years ago, and there's a lot of talk of private markets still having quite a correction to come. Do you think valuations are significantly down to had you done this a couple of years ago? Was it a fairly easy process?
I mean, I suppose we are incredibly lucky in that my co-founders and I have had a lot of experience in this space. Dr. Gabriel Walker, our chief scientist, and Mark Stevenson, who advised, amongst others, the Ministry of Defense on net zero. And myself, this is not my first rodeo. And as you pointed out, I have had previously both started companies and led Google for Startups. That sort of put us in the right place, I suppose, to be able to secure a very healthy funding round that we believe is going to lead us to all the future success. Broadly, if we talk about markets, I suppose climate tech is still a very interesting category. It's a fast-growing market, and there are some exceptional founders in this space. So when it comes to climate tech broadly, I'm very optimistic.
Marta, thanks so much for joining us.
Thank you so much.
Much appreciated. Still to come here on Ian King Live, we'll take a look at how global markets are starting off this morning. We'll be right back.
There's always more to the news than a headline. We want to discover, to delve a little deeper, to find out what's really going on. Explanation, analysis, the people at the heart of every story. I'm Neil Patterson, and this is the Sky News Daily Podcast. Alex Crawford joining us now from Ukraine.
Their personal possessions are all scattered around the place.
Our economics and data editor, Ed Conway, try and make sense of the big numbers for us.
Things can change incredibly quickly, and that's what they have done.
So, by the end, we'll hopefully all understand what's going on in the world just that little better. Available wherever you get your podcasts.
Enormous explosion has just come down. I'm Stuart Ramsey, and I'm Sky's chief correspondent.
You either live and recover, or you die.
Welcome back. Let's have a look at how the markets are performing. Firstly, Asian markets, seeing, as you can see, Australia down 0.1%. Hong Kong is up. It had been down earlier in the session. So a sort of slight improvement through the Asian trading session. Of course, worth pointing out that Chinese equities, which ripped higher late last year and in the early part of this year, have pulled back significantly in recent weeks and months as fears emerge about quite how strong their post-reopening, pandemic reopening bounce back will be. Let's have a look at European trade. Similar story in terms of opening a little bit soft and improving a bit through the session. France is still lower, but hardly lower, down just 0.1%. It had been down close to 1% early in the session. The FTSE is just lower itself. With everything else mixed, with a little bit of gains there for Germany. As you can see there, the FTSE is down 0.2%. In terms of the sectors, real estate and media are the best performing, whereas food and beverages and oil and gas are the worst performing sectors. Let's have a look at currencies. The DXY, the dollar index, hitting a 2-month high of late, partly on hopes, of course, around the debt ceiling, partly, of course, on interest rate expectations. But that just reversing the last couple of months, the decline that the dollar had over the prior 4 to 5 months. You can see sterling against the dollar at about 124 this morning. Finally, oil prices. We're seeing WTI at around 72 and Brent at 75.30. Both are down, as you can see, though, this morning, down about 2.2% now for Brent. So oil prices just worsening through the course of the morning, 71 for WTI and 75 for Brent. Let's get more on the markets. Guy Ellison, head of UK equities for Investec Wealth and Investment. Great to see you, Guy. Thanks so much for joining us. First, let's just touch on the big topic of the week, or certainly was last week, and maybe it won't be anymore, but on this hopes for a deal for the US debt ceiling. Where do you think markets are relative to that? If a deal now gets over the line, is there much upside still to come, or is the other direction more profound? If a deal falls apart, which isn't likely at this point, would you see a big collapse in markets?
I think you're right that sentiment would take a big hit if we saw, the deal fail to get through Congress over the course of this week, particularly with that ex-date of the 5th of June looming. That's now very, very close before the US starts to run into some serious decisions about how they spend their money if they can't agree a new debt ceiling. But no, I think if the deal does pass in a fairly orderly way through Congress this week, you'll see a little bit of a relief rally in the market, certainly at the shorter end of that US fixed interest market, T-bills, where some of the yields have been very elevated over the last couple of weeks. But as you saw from the market reaction today, the market's fairly nonplussed by what was a very positive development over the weekend.
I wanted to touch a little bit on the outlook specifically for UK equities at the moment. I mean, for a long time, it's been a case of, the US is where the growth is, perhaps Asia and other emerging markets are where longer term opportunities was. Are we seeing now the UK in a relative sense more attractive versus the rest of the world than it has been for quite some time? The growth outlook is not fantastic, but it's at least turning a corner and improving a little bit.
Yeah, indeed, and the likelihood of a significant recession, both in the UK actually and in Europe, as this year progresses, has been reduced, and now some forecasters not expecting the UK to enter recession this year. What the UK stock market has really compared certainly to the US is a huge compelling valuation story. You know, the UK market as a whole trades on much less demanding valuations than the US market. And even if you compare like-for-like companies between the UK and the US, the UK names are trading on a big discount. So yes, we'd expect to see ongoing inbound interest from international investors, perhaps international acquirers. We're no strangers to M&A from overseas investors. You know, the dollar relatively strong against the pound, UK assets trading cheaply. It wouldn't be surprising to see a bit more M&A coming into the UK market. But yes, with the economic backdrop looking less bad, let's put it like that, I think the investment case for the UK does still stack up.
It's interesting you say like-for-like comparisons, because I guess the key sector where you can't make like-for-like comparisons is tech, because the UK hasn't enjoyed the same innovation over the last 2 decades as the US. Just touch on that for us, that this surge year to date that just a handful of enormous US tech companies has had, and whether you think that is a good sign for the US market or a bad sign. And just further than that, if you did eventually see a big correction in US indices, would that drag down the FTSE 100, or given this valuation difference, could it hold up?
I think if you were to see, starting with your last point, US market equities and US indices sell off, it will probably be led by that same cohort of mega cap companies that have led the index higher. You know, the fact that the Nasdaq is up nearly 25% year to date, far outstripping the S&P, just shows you how significant the $1 trillion club of companies has been in leading the US market higher. What could change that narrative? Perhaps the higher interest rate environment in the US. Certainly the market after the regional banking crisis in the US had been pretty confident in anticipating, as being very close to peak US rates and some quite aggressive cuts coming through later this year. That narrative has now unwound. The economic data in the US remains fairly robust. The employment data is still very good. And as we saw on Friday, that inflation print still running hot in the US as well. It probably means that the Fed has got a couple more rate moves in them, and certainly expectations for the back end of the year, when the market had been pricing in rates falling back to 4.5% or so, now looks very optimistic.
Guy Ellison, thanks so much for joining us. Much appreciated. So come here on Ian King Live. What goes around comes back around. Why flip phones are experiencing a surge in demand. We'll be right back. Welcome back. Earlier this month, the head of the London Stock Exchange, Julia Hoggett, called for company bosses in the UK to be paid more in line with other countries, particularly the US, in order to attract and retain the best talent. Well, now a survey of non-executive directors has found that the issue of pay may be harming growing companies in particular. Let's talk now to the co-head of corporate finance at FinCap, Christopher Raggett. Thanks so much for joining us, Christopher. It's a really interesting report that you guys have been doing. To just talk us through the key takeaways from your analysis.
Sure. So what we wanted to look at was the attraction of human capital into the markets. But obviously, there's a lot of navel gazing going on at the moment in public markets. Particularly, there are 9 separate task forces that have been set up by government and industry alone. None of them looking at human capital. So what we wanted to do is examine if the public markets were attracting the right talent as well. And what we found, frankly, is that it's not, particularly when it comes to smaller or growing companies. And I mean, the key findings from the survey were that 61% of non-executives had turned down a role because they felt that the time commitment wasn't reflected in what they were being paid, but also that 88% of them found that the role of growing companies was either different or significantly more onerous than larger companies.
And so your report is focused, as I mentioned in the intro, in non-executive directors who do tend to have to be brought in from the outside, as opposed to executive roles often promoted from within. Do you think it's a simple case of offering them more money, or is it more nuanced than that, as you're sort of suggesting that perhaps the responsibilities are more than what they might have expected for a non-exec role?
Yeah, it is definitely more nuanced. I don't think we're arguing, or anyone would argue, that with the cost of living crisis going on, that non-executive directors should necessarily be paid more. It's more about having creative solutions around how they're paid and not having a box-ticking exercise where you can't use those creative solutions because you'll be voted against at your AGM. So that's what we're advocating, rather than just plainly saying more pay.
And in your analysis, were there differences between the biggest companies versus the smallest companies? Who's struggling the most to attract the right type of non-execs?
It's definitely the smaller companies that we're focusing on, the growth area of the market. I mean, the strictures are the same, whether you're big, small, growing, or whatever. You still have the same responsibilities as non-exec and as an exec. But in essence, with a number of high-profile, shall we call them, failures on the public markets, the scrutiny that non-executives are under, particularly in the growth area, seems to be that much higher.
It's interesting that that's a sort of negative or a challenge. I mean, again, to the comparison to the US, obviously, clearly, the pay is lower for all sorts of reasons. But equally, British boards tend to have a little bit more power. You don't have as many chairman and CEO roles merged, where it's a sort of yes man, yes woman approach. That could, or perhaps should, by the right type of hard worker, be seen as a positive. More responsibility, but more power. But are you saying that's been seen as a negative because people do just want to have a sort of easy job if they take a non-executive role?
No, I think that's fair. I don't think it's fair that anyone would take on a non-executive role for an easy life, because it's not, and that's what the report's showing us. But I don't disagree that it's a privilege to be on a public market. You know, you are essentially saying that this company is well enough governed that all and sundry can buy their shares, and as I say, that is definitely a privilege. But I think what we are doing at the moment is that the governance codes were intended to be comply or explain, particularly the excellent QCA corporate governance code. And I think now with the pendulum has swung so far the other way that actually it's become comply or else. And the flexibility that's baked into those codes just isn't being used. So we're not saying that anyone shouldn't be under scrutiny or that you should denigrate the public markets. But what we are saying is that there should be some more flexibility around how boards operate and how they're remunerated, so that you can actually avail yourselves of what the governance codes are saying, because that's definitely not happening at the moment.
And Christopher, what is the advice on how they're remunerated? I mean, is it more stock and more performance-based pay, or what?
I think so, but it has to be bespoke, ultimately, particularly in the growth company world, where the challenges are different and the challenges are nuanced themselves. So I think what we're advocating for is a bespoke approach where just because someone's getting options or whatever doesn't actually stymie their independence. What we're saying is that as long as it's right for all stakeholders in the business, there should be a more flexible approach around stock options and incentivizing non-executive directors to give up their time, their experience, their mentorship, their guidance in a different way.
Christopher Raggett, thanks so much for joining us.
Thank you.
Now, the Finnish mobile phone maker Nokia is relaunching one of its classic flip phones, citing a surge in interest by Gen Zs and millennials. The Nokia 2660 flip phone was first launched back in 2007. A bit of nostalgia for us here, and is now back on the market, with Nokia saying so-called dumb phones are in fact growing in popularity as people seek to limit their screen time. Well, I'm joined now here in studio by Lars Silberbauer, the Chief Marketing Officer at Nokia Mobiles. Thanks so much for joining us, Lars.
Thank you for having us.
So this is really interesting. So I'm interested that you're saying people want to limit their screen time. Totally get that. But are you saying that millennials and Gen Zs are leading this move themselves, rather than being told to by boring parents and the like?
Definitely. I think we all know that generation is not just doing what they're told by their parents. And we see this trend starting in the US, really starting last year. We can see that we really have doubled our market share over the year in flip phones. We see it starting in the US and now coming to Europe, with really Gen Zs leading this trend. But it's a trend we also see in the older generations, really, that people want to take ownership of their own digital life and want to limit their screen time.
So again, really interesting that this is happening, or you guys are pushing it to happen via a new hardware setup, by a new flip phone. I mean, has it got a different operating system, different functionality inside that does lead to that headline, dumb phones being applicable label? Or can it, once you open it, can it do everything that an iPhone or it would be a different operating system that the best Android phones can do?
I think like these flip phones are, of course, like it's 25 years since we launched the first flip phone, and these phones you can call, you can text, and you can play Snake, and then you can get a lot more time to actually enjoy life. And I think that's the important part. So the important part is not really what the phone can do. The important part is what it really allows you to do, and that is that you realize that you actually are being caught up with constantly being notified, getting social media posts, and really being dragged into digital. So these phones are actually a way to realize that you can actually have a much more enjoyable moments in life than on the phone.
I'm not sure Snake would, returning to my phone, would limit my screen time. It takes me back. Anyway, so what's the operating system on this? Is it an Android operating system, or is it, again, a Nokia Symbian developed system?
So it's not a smartphone, so it's a feature phone. So it's a classical operating system on a feature phone. So it has all of those traditional things on a feature phone.
Because I'm interested, therefore, that you're flipping back to the idea that hardware can drive perhaps Nokia to have a significant foothold again in the not smartphone, in the handset market, which of course it used to be number one. It fell from grace, and largely I think it's fair to say it fell from grace because of software. It didn't develop a very user-friendly software like Apple did with iOS or like Google did with Android. Does Nokia hope, weirdly, that going back to old, less impressive software can give it a strong position in the hardware market once again?
I think first and foremost, it's important to say that we are already selling millions of phones every month. So it's not it's a fairly big number of phones that are being sold by Nokia. So we're not a small player in that sense, especially not in the feature phone market. And I think when it comes to smartphone, we would also love to sell you a smartphone. But the reason why we're introducing flip phones is really because we want people to realize that we can see this trend, and we're answering this trend about people wanting to take ownership of the digital life. So typically you would say like your smartphone is a digital assistant, but sometimes it do become a digital dictator. Definitely. And that's really what the trend is about, and that's what we're trying to help people to realize and to really experience.
And just finally, are these a lot cheaper than a Samsung Galaxy or an iPhone?
They are a lot cheaper. They're around £65, so a lot cheaper than the normal. So we don't think that people would switch from smartphones to a flip phone, but they might add a flip phone to their range of devices.
I think it's very interesting. Lars, thanks so much for joining us. Thank you. Very much appreciate it. Now, some breaking news. The chair of the COVID inquiry has granted an extension for the government to present its evidence. The deadline has been moved from 4 p.m. today to 4 p.m. this Thursday, the 1st of June, so a few days extension there. We're still to come here on Ian King Live. I'll be speaking to the chief executive of Hollywood Bowl about its latest results and the popularity of 10-pin bowling here in the UK. We'll be right back.
There's always more to the news than a headline. We want to discover, to delve a little deeper, to find out what's really going on. Explanation, analysis, the people at the heart of every story. I'm Neil Patterson, and this is the Sky News Daily Podcast. Alex Crawford joining us now from Ukraine.
Their personal possessions are all scattered around the place.
Our economics and data editor, Ed Conway, try and make sense of the big numbers for us.
Things can change incredibly quickly, and that's what they have done.
So, by the end, we'll hopefully all understand what's going on in the world just that little better. Available wherever you get your podcasts.
Enormous explosion has just come down. I'm Stuart Ramsey, and I'm Sky's chief correspondent.
You either live and recover, or you die.
Global insight, made local. Invest in your future. Sky News Financial Reports, sponsored by Interactive Investor. Invest in your future. Sky News Financial Reports, sponsored by Interactive Investor.
Welcome back. Time now for a look at this morning's business pages. Let's have a look at some of the key stories. Well, the Financial Times leads with news that Labour's planning to force major landowners to sell off plots cheaply if the party takes power in an effort to cut the cost of building new homes. Let's have a look also at the Telegraph. They are reporting that Labour's plan for pension funds is under attack, with Schroders saying fund managers should not be inhibited by government interference. Interesting, on that topic in the Times, Simon French from Panmure Gordon highlights 3 reforms which he says could transform perceptions of the stock market. An interesting article about why the difference in the UK and the US valuations continues to last and some possible reforms. Well, with me to discuss all of this is the business editor of The Sun, Ashley Armstrong. Ashley, great to see you. Why don't we touch on that story that kind of crossed the last two, the Telegraph and the Times story that we picked out first? Because clearly there's a big valuation gap between the UK and the US, and everyone's trying to wonder how it can be closed. One of the areas is, this idea of forcing pension funds or domestic investors to buy more UK stocks relative to international. Interesting to me in the Simon French article is the idea that particularly the UK public pension funds should be forced to do that. And it's not as unfair because they tend to be defined benefit schemes. So the beneficiaries have a set amount of money they'll get, as opposed to the idea of restricting them from buying something that might grow faster than a UK equity.
Yeah, no, I think it kind of it's very much bringing together all those debates at the moment. Why is the London Stock Exchange flailing in comparison to the US? Why are so many British companies choosing the US? Why is the liquidity not deep enough in this country? And I think, as we've seen in the Telegraph as well, Schroders hitting out. I had the boss of PensionBee, we've had the boss of Aviva, all kind of criticising Labour's plans to create this 50 billion super growth fund with our pension funds, because essentially our pensions are ours. It's interesting that the government wants to use them as a piggy bank to kind of fund the UK economy. Simon French, who's a brilliant economist commentator, you know, the things that he's pulling out about the defined benefit schemes, well, very few people have DBs anymore. That was kind of yesteryear. But the idea is that it's, you know, kind of a set guaranteed pension payment. So there's lower risk to you or I, if we were to have one, rather than actually somebody kind of investing in something through Scottish Widows or AXA or the other pension funds and not being able to see exactly where they're investing. It's definitely a debate that's going to roll on, because there's this big argument about, you know, where should our pensions be going? Should they be going into UK infrastructure that will ultimately help the economy?
Interestingly, I think the biggest factor, which can't be tweaked around the edges with policy, is the outlook for the FTSE 100 versus the S&P 500.
Yep.
Actually, it'd be hard for it to be as bad as it was for the last decade, and maybe in a relative sense, we'll be turning the corner there with UK companies doing a little bit better as they did last year. Let's touch on another story that's in pretty much every paper's non-business section, and my question to you is whether it should be in the business section as well, and the issues going on at this morning on ITV. The share price for ITV this morning opened down 1%. It's now back to flat or so. Do you think all of that kind of stuff is a threat to the business model? And when we look at the sort of 5-year tenure of Carolyn McCall, how has she done overall?
Yeah, well, I mean, the Sun has really been leading the way on the whole kind of this morning saga, so I don't think that I'll be kind of jostling with them for it to be on the business page just yet. But I think it is interesting with Carolyn McCall. You know, in December, she very much said that she was halfway through her job, and she said that privately. One of the key things that she's got in her defence is that she has seen this ITVX, you know, their big streaming platform, and really doubled down on that as a kind of UK challenger for free streaming, which is particularly interesting given that Netflix and all the rest of them are hiking the prices for subscription. It is a difficult time, and especially when ITV builds itself so much on the content and the talent that it has. And this morning was a huge show for it. It's not made it any easier for Carolyn, I would say. She's very respected through her time in EasyJet, but she's also been there 5 years. The share price is down almost half since she took over. That's not all her fault. A lot of that was the COVID lockdowns and all of that kind of UK sell-off that we saw. But it doesn't make it any easier.
Well, Ashley, thanks so much for joining us this morning. We're tight on time, so sadly don't get to the third story, but I'm sure we'll have another chance soon. Thanks so much. Ashley Armstrong, business editor at The Sun. Now, with many children off school for half-term, families will be looking for ways to entertain them this week, which means leisure operators such as bowling alleys will no doubt be busier than usual. Well, Hemel Hempstead-based Hollywood Bowl runs 64 bowling alleys across the UK, and this morning it reported pre-tax profits of £26.7 million for the 6 months to March 31st, down from £33.4 million a year ago, but with a record first-half revenue of £110 million. Well, joining us now is the Chief Executive, Stephen Burns. Stephen, thanks so much for joining us. I want to get into the nitty-gritty of these numbers in a moment, but big picture question first. I mean, do you think we're back to the ideal balance that you saw pre-pandemic of people's leisure spending being as much in-person, out-of-the-home interactions as staying-at-home spending?
Yeah, I think things are starting to certainly come back to a little bit like they were pre-pandemic. I mean, the pandemic did accelerate a number of trends that were already under development as people were already looking for spending their money more on experiences rather than things. And then being forced to stay at home for such a protracted period of time meant that when we were allowed to go out and do things, we did them to excess. So I think we are starting to see things return a little bit back to the way that they were pre-pandemic, albeit on a slightly higher base.
That said, is it being offset by the cost of living pressures and a tepid economy, if we use that word?
That's not actually something that we're seeing in our sector. We are very fortunate in that 74% of our revenues aren't subjected to the inflationary cost pressures. So 50% of our revenue is bowling, and that's 100% gross profit, and 24% of our revenues come from the amusement machines that are on a fixed cost or fixed revenue share. The remainder, which is food and beverage, is subject to quite significant cost pressures. But the offset that we've been doing regarding our pricing, which has helped drive volume, has helped us maintain our profits. And actually, as you've seen from the numbers this time around, that whilst profits are down on a like-for-like basis versus last year, it's not true like-for-like because of the £7 million of reduced rate of VAT and rates benefits that we got from the government during that COVID-affected period. So on a normalised basis, revenues and profits are significantly up, actually up over 20% versus the same period last year.
How popular is 10-pin bowling in the UK, and how penetrated is it? Relative to the US or something. Do you think there's significant grounds for expansion here in this country?
Well, I mean, 98% of the UK population have at some point been bowling in their lives, but it's not something that you do on a really frequent or regular basis like you might see over in the US. The actual size of the UK bowling market has stayed pretty static over the last sort of 10, 15 years, around about 340 bowling sites in the UK. We believe there's opportunity for about another 20 Hollywood Bowl centres in the UK, which is why we turned our attention to North America last year, acquiring the Splitsville and Striker brands out in Canada. We've actually nearly doubled the size of that business since the acquisition in May of last year out in Canada.
Stephen Burns, Chief Executive of Hollywood Bowl, thanks so much for joining us. Very much appreciated. Before we go, let's just recap for you how the markets are looking. We started the futures on European trade higher. When we opened, it was lower, with the French market down as much as 1% at one point. But we've steadily improved since the open. You've got Germany up 0.5%, France down now only 0.25%, Italy's higher by nearly 0.5%. The FTSE 100 is down, but only about 1/3%. Sterling this morning, as you can see here, is up a nice 0.5%, a decent move to 124. The broader dollar index has had a decent bounce back on hopes of a US debt deal. That does it for Ian King Live today. Much more coverage coming up with Kimberly Leonard on Sky News here next.